it's really the typical kind of real estate cycle, right? Which is where everybody starts building like crazy because they can get the debt, and then the market gets into an overbuilt situation, the debt dries up, right? Nobody will lend anymore, and then the whole thing starts again, and the banks won't start lending again until the market
Hmm.
reaches a new equilibrium.
I want to talk about getting rich in a recession. If you don't know, recessions, generally speaking, last between 12 and 18 months, where expansions can go from 8 to 12 years. Now, I've been doing this for 22, 23 years. I've bought in every cycle, but I wanted to be very clear. My life-changing wealth, the best deals I've ever done, the home run of home runs were done in recessions. And if you've been following my channel for any length of time, you know that we were getting prepared all the way back in 2019 when we thought we would have a recession. So I've been licking my chops. I want to talk about getting rich in a recession. I want to do this with the one and only Jonathan Plumley. How you doing, sir?
I'm doing great, Michael. Good to see you this week. When we thought maybe it wasn't going to happen because of my internet issues, but here I am. So it's good to be on the show.
Yeah, good karma. The audience loves it when we talk about syndication apartments and getting rich. So I thought I would talk with you. You like me thought there was something around 2019. It was coming. We were headed that way, and then obviously the pandemic, threw over the apple cart. But now it does feel like one is coming, right? They are
Yeah.
natural, and they're typically short, right? Certainly shorter than expansion. So I thought I would just ask you, how are you planning? Where are you looking? What are things are you doing to get ready to take advantage of the recession?
Well, I guess, I'll be honest and say there's nothing specific that I've been doing that's related to getting rich during a recession. It's just that all the stuff I've been doing all along is going to be really useful during this, you know what I mean?
Yeah,
So
of course. Yep.
all of the years of building, a list of investors, you know, being present on social media, doing this show, my show, things like that. That all is very helpful for now when it's time to take advantage of these things that come up. So
Yeah.
so how is this going to affect me personally? Well, so what this means is that I'm in a position now because of the investors I've cultivated and the other, people that I can partner with that I've cultivated over the years, that if I find a really spectacular deal out of all the carnage, I'll be able to take advantage of it. Right. And the unlike the last time when I wasn't in the business during the crash, I did come in right after the crash, so there were still a lot of good deals around. But it wasn't, I was already hearing stories in 2011 about people telling me it was too late, right? That I missed all the good deals from 2009, and it's probably true. I mean, people were buying apartments for $7,000 a unit, in 2009 because the banks were just trying to get rid
Yeah.
of them. I don't think that'll
It,
happen again, but I think multifamily
yeah.
is on sale right now.
Yeah.
Let's put it
When
that
I
way.
when I think about recessions and I loved how you answered that question because that's the right way to go. You don't get ready in a recession.
Yeah.
Because again, when you think about the duration, a recession, let's call it a year, it takes a lot more than a year to get ready. So what you shared is perfect is Michael, I've been doing this for 4, 5, 10, whatever years to get ready for it. Right. You've been building relationships. You've still been doing deals. You've been exiting deals. You've been returning capital. You've been educating. You've been and also one thing you didn't talk about is you never stopped underwriting.
Yeah.
Even when deals didn't make sense, you never stopped underwriting and you looked for value and looked for opportunity. You did that so well that you actually pivoted out of multifamily into what I'll call boutique hotels, for lack of a better
Yeah.
term, because that's where the value was. And you're always seeking value, and you never. That's a big deal, man. You can't get ready in a recession. You're either
Yeah.
ready when it comes or you're not.
So
And We're ready.
Yeah, I mean, but listen, I will just sort of caveat that by because I don't want people to feel like, oh, it's too late, they're going to miss it, and then they're just going to like tune out
Yep.
and not
Yeah,
take
yeah.
advantage. So I do, what I would like to point out is that a lot of people are more ready than they think they are, right?
Tell me.
So yeah, so let's give an example. Let's say that you are a doctor, right?
Hmm.
Just to pick an example.
Sure.
You're already
High income earner, right? Yeah, yep,
yeah,
exactly. Yeah.
you're already surrounded by other high income people who very likely want to invest in real estate. You've just never had these conversations with them. So you have the network already built. You just haven't ever uh, sort of primed the network or like, you know, taking advantage of the fact that you have this network, right? It's very difficult if you're, say, a kid fresh out of college and you're trying to build a network of investors that, you know, that's going to take you some time. You may not be able to do it in time. But if you're already like in a profession of whatever kind, you have the network already built. You just have to start talking about this with your colleagues and telling them, hey, I'm I think the time is going to be right to pick up some really good real estate deals, and start having conversations with people. That's what you need to be doing to prepare before the opportunity strikes. Because if it's going to be a little bit harder, like if you find a great deal and then the first time that these people are hearing from you about this
Mhm.
great deal that you have and you want them to invest, it's going to be much harder. But if you've been kind of like drip, 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 like telling them
Right.
about your adventures in real estate and how you're like, you know, you think it's really going to be a good time to get into it, and it'll give you that time to have those conversations with people um, who think that, oh, well, the market's crashing, so it's a bad time, I should wait, right? To have that conversation with those people about like, hey, no, this is actually the best time to get into the market because this is when, because we know what's going to happen. The
Oh
market
yeah.
is going to bottom out and then it's going to start heading back up again. And if you wait till it heads back up again, you're going to miss the best opportunities. So this point where everybody is feeling scared and anxious about the real estate market really is the time to be starting to like look for deals. And it's happening. I mean, I'm starting now to see that first trickle of like people posting on social media about the deal they bought off of, from out of foreclosure or the short sale that they were able to buy, right? It's starting to happen. The floodgates have not yet opened, but that dam is like there's pinhole leaks in
Oh
that
yeah.
dam. And, so it is really the time to start to talk to
Couldn't
your colleagues about this.
I couldn't agree more. I mean, again, part of this whole process of getting ready and talk about getting rich in the recession is I'm trying to motivate people to start now. It's
Yeah.
certainly not too late now. And you're absolutely right. I've raised millions of dollars over the years, a couple of different times. One time when we paid 10 or 12% interest just to be the first position debt. And another time I brought him in is still debt, but I gave him 6% plus 20% of the upside because my hold time was different. One time was long-term hold, bought stupid low. The other time was, hey, I'm going to be in and out in 100 days because they were flipped. So again, you can get creative. You can find, what's important to your friends by having those conversations. And the journey is what people want to see. Like if you just pull up your friends and you go, "Hey, I found this 100-unit deal, blah blah blah," and you haven't had that conversation, you should be expected to be ignored. But
Yeah.
if you talk about, "Hey, I'm looking and, I've been looking for, 77 days in a row and I've done, 50 underwriting and this one is the best I have seen." That probably gets their attention
Yeah.
and you can start having deeper conversations.
Yeah.
The oth
And I'm sorry.
Go ahead. No.
And you don't need to do 100 units, right? I mean, I've been
No,
writing about
I've
this. Yeah, yeah.
yeah.
I've been posting. The reason I just want to flag this is because I've been posting on LinkedIn. And if you guys are not following me on LinkedIn, please, come follow me and connect with me. But the yeah, I've been posting recently about sort of pushing back on this idea that like, oh, you have to do 100 units your first
Yeah.
deal, do a big deal because the work is the same, whatever. Like you really have to get started where you can get started and don't get hung up on things like, oh, I should do a bigger deal. Because
Love it.
frankly, doing a bigger deal is really hard. It is more work. I mean, it's a lot more psychological work, but it's more work
Mhm.
to raise the money for. Like you could need a
Oh, yeah.
lot more investors. Like there is more work involved. It's a lie to say, oh, it's the same amount of work. So um, get started on a fourplex if that's where you can start. Like
Absolutely.
if you're a, whatever your profession is. I mean, it doesn't have to be a doctor. It doesn't even, you don't have to be highly affluent. As long as you have a network of people that trust you, you guys can go in together as partners in a fourplex, right? Like
Yeah.
this is how you get started. This is how many very wealthy people in real estate have gotten started, is just with something small. They do one, then they do another, then they do another. Before they know it, they've got 10
Mhm.
units. Now they can do a cash out refi, and now they can buy something bigger. I mean, it's how
Yeah.
you got started. So
Absolutely.
it's just, don't get hung up on like these numbers or
Yeah.
this
I totally
vanity
agree.
stuff that people post on social media. It's BS. Like, just start.
I love that. Just start. The other thing I don't know if you're seeing, but Ken McElroy is painting a pretty clear vision of what he sees coming in the next couple of years in multifamily. And I'll do my best to parrot what I've watched and heard. I'll go watch Ken McElroy for kind of his takes on it. He's talking about this a lot, but basically he's like, yeah, you know what? The next 2 years are going to be painful. There's going to be blood in the streets. Uh, but do yourself a favor, get ready and buy, because there are going to be some great deals, and it will go by fast. And then the follow up to his thought is, hey guys, look at 2027. There's no building going on. So yes, we have a lot of inventory coming. We've got some bad debt and some people who need to bust out. It will be rough, but if you look up just over the horizon, we're not building anything. So again, Ken's like, yeah, the next 2 years are going to be rough, maybe flat rent growth, maybe down a little bit, but look up, and it's going to get good again. And Ken says that as somebody who did the last crisis, and the same thing happened, right? Building was going gangbusters, and then it crashed. And he's like, well, guess what happened for 10 years after that? So
Yeah.
I think Ken's idea, it makes a lot of sense to me. What do you think?
Yeah, I think that makes a ton of sense. I mean, it's really the typical kind of real estate cycle, right? Which is where everybody starts building like crazy because they can get the debt, and then the market gets into an overbuilt situation. The debt dries up, you're right? Nobody will lend anymore, and then the whole thing starts again. And the banks won't start lending again until the market
Mm-hmm.
reaches a new equilibrium. But then, if you think about how long
It'll
it
be
takes to
late.
build,
Oh
yeah.
yeah,
So,
it'll be late.
so even if the market, so let's just say that all the excess inventory in some of these markets is absorbed by the end of next year, right?
Shoot, even say it's 26. I mean,
Right.
so
Well,
be it.
but
Yeah.
even let's say it's early. Let's say it's all
Okay.
absorbed by the end of 2025.
All right.
It's only at that point that the banks will start to lend again,
Oh, I
right?
got you. Yep.
So, which means that nothing is going to hit the market
Oh, for years.
for at least two
Yeah,
years after that,
exactly.
right? So
Yeah.
now obviously there's going to be, it's not like nothing will get built, because there are going to be things built here and there. There'll be local banks. It'll be,
Yeah.
it's always very granular and market specific, right?
Correct.
So, but just as a broad proposition, and when Ken McElroy says nothing is going to get built, I mean, what he really means is
Yeah. Just
the
below
amount of
trend. Yeah.
construction is going to drop a lot. But that doesn't
Correct.
mean nothing is going to get built. But
Valid.
it,
Very true.
yeah,
And that was
but
my word. That maybe he didn't use nothing. That was maybe my
yeah, but well, I
personal.
mean, listen, it's a figure of speech, right? I mean,
Right.
a lot of people are saying very similar things because that's just the
Okay.
way the cycle works.
Mm,
That being said, there are markets that are not going to go through this as well,
true.
right?
True.
There are markets like the Midwest where not nothing, overusing this word nothing, very not, there was not as much construction in the Midwest as there was in the Sun Belt,
Correct.
because of kind of like the herd mentality aspect of real estate. And so those markets right now are the ones that are experiencing rent growth, and they don't have a huge pipeline of supply coming forward, right? So those markets are performing well already, right? There's
Yeah.
right this minute you can go and buy deals that are working, and you don't have that the cash flow problem, or the occupancy problems that a lot of other markets are experiencing right now. However, what is interesting is that, the banks in those markets too are also skittish, right?
Mhm.
Meaning that it's harder to get the debt, and it's which means there's going to be less competition, right? So if you are able to get the debt and get the equity together, you'll be able to find good deals.
Yeah. When I think about what's coming over the next couple of years, and there's this general notion of distressed real estate. I don't think people really understand. I see there's three levels of distressed real estate investing. There's obviously the traditional, slumlord property hasn't been maintained. All the cash flow has been sucked out. Then there's distressed debt, meaning that, we're going to see a lot of that in commercial where the debt resets, the debt's actually the liability. But then there's also kind of the seller. The seller could be in a bad position. Maybe there's other assets he has that are, going bad. So it looks like we've lost Jonathan. He was having some internet issues, so I'll just keep just talking to see if he comes back. But when I think about getting rich in this next recession, I really want people to realize there's kind of those three things to pull on. We don't only need to be doing driving for dollars and looking for, ugly properties. We also should be networking with banks, community banks, figuring out where the issues are, and also sellers, right? One of the things that I want people to know is I am open to overpaying for the right multifamily property, 5 to 40 units. And what do I mean by that? My intention is to hold these properties long term. I'm gonna let Jonathan in and see how we're doing. Think he's coming back. How you doing, Jonathan? Can you hear me?
I can hear you now. So my internet went out again, so I'm on my phone now.
Oh, there you go. Well, it's okay. I've been kind of riffing on a topic, hoping you would come back in. I want to share with you an idea,
Yeah.
just to get your feedback. I'm excited to do my biggest units, up to a 40, maybe 50 unit building in this cycle, like 10, 20, all those. And I'm actually putting it out there, Jonathan, that I will overpay for one of these
Okay.
properties. And let me explain. My intention with these building is I'm not going to flip it. I'm not going to extract value. I'm not going to, do any of that. So my time horizon is forever. That's point one when I say I will overpay. Point two is I'm not an idiot. I certainly will overpay on value, but I'm going to get terms that allow me to hold the building forever. So
Yeah.
I will be looking for below market interest rates, maybe a balloon out at 10 years with no payments, whatever it is. And the reason this is important is if you find the right seller who's ready to get out, you can structure a crazy win-win opportunity.
Yeah.
Right? You can structure, you could give them, like, let's say the building's worth $1 million. I'll pay 1.2, but we'll do a 1-1 loan at some really low interest rate. He gets a little payment, he or she gets a little payment. Then, oh, by the way, they pass on. That note then becomes an asset to the family. They get their basis raised, and bingo bango. So there's lots of ways you can do this. So again, I wanted to get your idea. I'm putting it out there. I want a message. I'm telling all the California brokers I'm willing to overpay for some multifamily in the Central Valley. It's got to make sense. I got to be able to hold it forever. We're going to get at least a large portion of seller financing, either a first or a second, because the numbers got to make sense. I got to be able to hold it
Yeah.
forever. What do you think of all that?
So yeah, I think that when you're investing for your own account as opposed to doing a syndication, you have your needs are different,
Yep.
right? And you have some more flexibility, right? So for one thing, you have ultimate flexibility on the timing because you don't need to return capital to your investors.
Correct. Yes.
So you can hold it forever, and you can really take advantage of the fact that real estate is your friend. So you can look at it, time is your friend, right? So you can really look at this in terms of the question you can ask yourself is, not, well, what kind of return can I generate in 5 years when I have to sell this? But, 20 years from now, am I going to be happy I bought this property at this price, right? And if you feel that, well, yeah, I'm going to be happy that I got this property for 1.2, even though if I had really,
Right.
wheedled the guy down, I could have got it for 1.1. Will it matter 20 years from now when it's worth $3 million? No, you will not care.
No, I won't care. And the whole idea of this, and let's use that example 1, 2, I'm willing to write, 2 offers, right? There's a cash number. And in this case, let's say it's 800 grand and the building's worth $1 million, just to kind of play this out. Right. So
Yeah.
the building as it sits worth $1 million. You want all your money today, Mr. Seller? Not a lot of buyers out there, not a lot of stuff. I'll give you 800 or 750. Or why don't I give you 1.2? You own the building free and clear. You've taken the cost basis to zero because you've owned it for 40 years. Why don't we structure a note where you get a little bit of income today? I can hold the building forever because we're controlling the payment. And when you pass on, the notes, part of your estate, and everybody wins.
Yeah, listen, I mean, I love this, and I've done this before, and I'll tell you, there is a very, very effective way to do this, which is that you submit your offer, right, with a little grid that you make, a little chart that says, like, bank finance or whatever,
Yeah.
and seller financing, and then you can just say, okay, here's the price I can pay if I'm going to a bank. Here's the price I can pay if you seller finance it, right?
Yep.
Obviously, it's going to be a bigger number.
Yes.
How much money are you going to get right now? X and Y. You can show probably a bigger number, right?
Oh, absolutely.
Then additional payments, right? How much more, and then you say, additional stream of income to you under bank finance, 0. Under
Exactly.
seller finance, it's like, X a year, whatever it is, 50,000 a year, right? And then total value of the deal to you. Well, and then you can also put it, and I put in stuff too, which is like stuff like, chance of the deal falling apart because of the lender, sellers with lender financing, 50-50 or
non-zero, right?
There's a check, check mark. Yes, it's possible, right? Yeah. Seller financing, zero risk. And so those things, when you actually put them side by side and make it so that the seller can really put it in context and understand how it benefits them to do seller financing deal, that can be really compelling to the right person.
In these big deals, I'm sure it's in your grid, but I just want the audience to see it. I would also put down the tax hit.
Yeah.
Right. You sell this building for cash. Let's just again say 800 grand. And let's say you bought it 40 years ago for, I don't know, 100 grand. You have $700,000 in capital gains. You also have depreciation. I don't know what the building is. Call it 80 grand. You're going to have depreciation recapture. You're going to have, your tax liability day one is going to be a big freaking number, and it could be much, much smaller if you do seller financing.
Yeah, absolutely. I mean, this gets into some obscure tax stuff that I don't quite understand, but it's like a deferred sale, and so it's an installment sale. It's treated very differently. And so they're not paying that whole capital gains, not all at once, right? They can defer that. So
the only tax they will pay is on, like if you bought it for 1.2, 100 grand down, that would be taxable.
Yeah.
And then that would be a percentage of the sale. And then it's the interest on the loan, and then the principal pay down if there is any, right? I would probably do interest only just to keep it clean. But yeah, I want people to know I'm willing to overpay in this cycle. And there's going to be plenty of sellers that are like, there's not a lot of buyers. It's harder to get financing. I'm willing to work out deals where the seller wins and I win. And you're right. The reason we can do this is because my hold period. I'm looking a lot longer than 2 to 5 years, right? I'd love to buy these buildings and own them until I'm 100. And there we go. So,
and it really depends on your perspective, right? Because if you're, if you were buying for yourself and you're like 6% return is what you want, then like you can pay that, right? You can pay that level. Whereas if you're, doing a syndication and you're like, wow, I really got to figure out how to get, close to 20% annualized return, that really affects like how much you can pay. So if you are buying for yourself, then you have I like this because you just have a lot more flexibility in this than you do with a syndicated deal, where you have to return capital. So yeah, I mean, I think it's a great strategy. And especially if, you're able to find just really well located property, just like, I mean, that's really what it's all about, right? If you find a really well located property that's really good, positioning for a long-term hold, then yeah, it's not that extra $100,000 that you pay. especially if you can finance the debt so that the
Yeah.
property can easily afford to bear the debt, then
Exactly.
you're in great shape. Yeah.
Yeah. Again, I think this is a lot of power coming with this. I've done this in the past. And again, what we're talking about here, folks, doesn't have to be a commercial building. It could be a house.
Oh yeah.
Right? It does. I mean, this concept of overpaying and having that conversation with the seller, you obviously have to find a seller that can say yes, right? You're not going to, this deal won't work for somebody who bought the house yesterday, right? There's
Yep.
no equity there. But again, it's a strategy. There will be people looking to sell. There will be people looking to sell where the asset is not in great shape. It won't appraise. The buyers are just, and the other thing, we've talked about this, right? It's going to become harder to raise capital.
Yeah.
And thus the prices on commercial are going to come down because the buyer pool, they just can't pay as much.
It's already happening. It's already happening.
So I'll overpay, folks. If you got a California multifamily property, let's talk. You know, again, we've got to do the deal right. But yeah, there's a lot there. I want to switch gears a little bit and talk about your boutique hotels. So again, I think you're in 2 of them now.
Yeah.
How's, you know, let's reframe for people that may not know. What did you identify or find and then just execute? What's going on in boutique hotels that there's a lot of value add that's possible?
Yeah. So this is my thesis on these hotels. There is a whole generational shift going on right now where, you know, a lot of people came into this business, a sort of mom and pop hotel motel business in 1950s, 1960s, 1970s, right? And they ran these things as family businesses. And now those people all need to retire, or, you know, maybe they've passed on and their children have now inherited these hotels. Either way, all the family's wealth is locked up in these assets, and they're very hard to sell at the moment, right? And usually the kids don't want them because the kids have moved on, right? The kids are not in the hotel business, right? They want to, they've done something else with their lives. They don't want to run these assets. So they can't be passed on. They need to be sold. And there's the other thing about the way that these businesses work is, you know, these mom and pops, they really don't reinvest in their properties, right? Or maybe they did back. You know,
yeah, they did in the beginning, but not the last 20 years. Yeah.
Yeah, I mean, we see this pattern where they seem to have been renovated in the 1990s and then not renovated since then. And so the properties, even if they're well maintained, they're just outdated. They need to be upgraded. They need to be modernized. And there's a limited number of people who have the skill set to go and buy these assets, raise the capital, and put in the additional capex that's really needed, right? Once that's all done, then there's a much bigger buyer pool of people who want to run it, you know, want to buy an asset that's already done, right, and stabilized. But when they're not stabilized, when they need capex, there are very few lenders who want to lend on this. Mostly these are, you know, you're looking at bridge debt. It's very expensive.
Very expensive.
Especially now, short term bridge debt. I mean, and the bridge debt, which used to all be non-recourse, now the lenders are asking for personal recourse, right? It's like, it's a very different lending environment, which means that any hotels that are on the market now that are in that condition are going to be very, very hard to sell. So that means on the buyer side, opportunity galore for these assets. And that's what I really like about this. And that seller financing pitch is very appealing right now, because you can say to the seller, look, Mr. Seller, frankly, this is the only way to do this deal. Either that or give me a big discount on it, because and I'll buy it for cash. Because nobody who needs financing it just doesn't make sense with the price you're asking. And nobody's really lending on these things right now. So if you need to sell or want to sell, this is the option that you have. And you know, what's going to happen is either the sellers are going to recognize that that's the option, or they're going to go sit on the market for a while, then eventually come back when they realize that that's the only option, right? So this is a good opportunity for you to buy. And whether you want to buy these assets to run as a hotel or to convert them into apartments, either way, you know, this works. And I'm definitely looking for opportunities like that too, where we can take some of these older assets. Maybe they're not kind of what we want for a hotel, but maybe they're too small, or maybe the location isn't as good, or what have you. But if there's demand in the market for apartments, then we'd be happy to convert them into apartments and then stabilize them and then sell them to a local apartment investor.
Yeah. I think there's a lot of opportunity coming. I think this recession is, you know, for the folks who are getting prepared that are having a thesis, you're going to really have a combination of things come together, right? We've already talked about the stressed lending environment, opening up opportunities for seller financing. We also have generation changes, right?
Yeah.
It's not, you know, it's not a surprise to anybody that baby boomers have more wealth than any other generation. And oh, by the way, they're getting older every day.
Yep.
And like you said, it's their kids and maybe even their grandkids want nothing to do with the hotel or the multifamily.
Yeah.
And there's really a couple options. You either sell it now when you're alive and get something, or you know what will happen. You're going to pass on. They're going to come to your funeral, and the next day they're going to list and fire sell the asset. You know, what do you want to do? I think there's a lot of stuff coming.
Yeah, absolutely. And I think especially for these hotels and motels, you know, this is an operating business, right? So the kids really don't want them because they've got to be there every day and run these hotels, and you don't really get a vacation from this business, unlike multifamily, right? But even for multifamily, I mean, a lot of these things were sort of mom and pop operated. They might be too small for professional management, right? So if you're local and you are able to go and run these yourselves and, you know, collect the rents and set up a system to operate the property, it's going to be a good opportunity for you to pick some of these assets up from, you know, these families who essentially just want the cash, right? I mean, they really want the cash rather than the assets.
They want to reduce their headache and they want to be liquid. Yeah.
Yeah, exactly.
Yeah. So it's really going to be interesting. And the other thing I want to talk about is kind of the timeline for when these assets might show up. Again, I have a thesis I'll share with you, and let me know where I might be off. In the last cycle, at least what I saw in Fresno, California, there's a building I bought, so I'll talk about that one. There was an 18-unit building. It was listed for 1.44 for seemingly years. Ultimately, what happens is the building gets foreclosed on. And what I found out later is the original buyer who had it at 1.44 had a seller financing note of about 1.2.
Yeah.
But the market turned. He couldn't pay it. The building went into repair, was half vacant. It was just an ugly situation. So ultimately, the note holder foreclosed and took it back, which I'm sure wasn't a fun process.
Yeah.
Then he reached out to me because I owned something else on the street, and we had a conversation, and we ended up picking that up for $700,000. So half what it was listed for. So this is my thesis. And again, I go back to my conversation with that local community bank that says, hey, you're good, but look at my file. I can't refi half these. So I'm thinking a lot of these properties will be listed at what I'll call wish pricing.
Yeah.
In the MLS or Crexi or LoopNet or all of them or whatever, probably for at least 6 months, if not a year. And then at some point, the lender's going to go, enough already, and start a foreclosure. Is that, because again, I want people to realize these assets will be listed in the public. They'll be listed at stupid prices. It's not like they're just going to show up on the, you know, the courthouse step one day. The owner is going to try to sell because the bank won't foreclose. They'll give them 6 months or a year notice. There will be some timeline, don't you think?
Yeah, I do think so. I mean, I think, you know, when you're seeing these multifamily foreclosures that are happening right now in the news, it's not like they were delinquent once and then the bank foreclosed.
Yeah.
Right.
Exactly.
Like they've been delinquent for a few months and they've been, that whole time they've been talking with the bank about trying to restructure or, you know, figure out a way to avoid foreclosure. And it's only because those discussions didn't work that the foreclosure has happened. So yeah, I agree that you should look at, you know, follow the listings in your area and just track deals that you find interesting and see how long they sit there on the market, right? Yeah. If they've been sitting there for a while, I mean, there's only one or two things that could be going on. One is, well, the seller doesn't need to sell, but they're just hoping to get a crazy price. And that's probably some small percentage.
Yeah,
Right?
so
They're
somebody
there.
hoping for a 1031 or whatever. They're like, you give me my number, I'm good. Otherwise, I'll keep it. There's some of
Yeah,
that.
there's some of that, but most
Yeah.
of those people they're listed because they want to sell, right?
Correct.
And so, and the longer it goes, the more desperate they're going to get, the more open they're going to be to a reasonable offer, right? And so, you should be looking at that stuff. Tag and listen. The second hotel deal I only got it because I had favorited it, even though it was under contract when I saw it.
Mm,
And just because I like the asset, I was like, this is the kind of thing I'm looking for. I want to remember, this deal. And then I got a notification when it fell out of contract
mm,
and called the broker that day.
yeah.
So you want to don't give up on properties that you see, that are in contract, because
Yeah, I agree.
listen, a couple of hotels I've been following have been in and out of contract several times already. So,
Yeah.
stay on top of them.
I love it. At the end of the day, folks, this conversation was how to get rich during a recession. Lots of opportunity. You could put, different strategies together, network, start doing the work, evaluate deals. Just, you got to get in the game. You got to get in the game. Jonathan, you have an amazing Facebook group. Where should we send them to follow and get some ideas?
Yeah, well, come to Apartment Investors Club on Facebook, but also I'm sort of increasingly shifting my attention to LinkedIn.
Okay.
So please follow me
That
on
makes
LinkedIn
sense.
and connect with me there. And you can always also come to my website, apartmentinvestorsclub.com, grab the free download that's there, get on my investor list. So there's lots of different ways to connect.
Makes total sense that you would focus on LinkedIn. It's a much more cultivated experience. There's where, folks, it makes a lot of sense that that's where you focus versus the craziness of Facebook. So it makes total sense to me.
It's funny. I mean, Facebook, we're kind of wrapping this up, but Facebook has changed a lot in recent years. It's not as good a medium for conversation as it used to be. And it also seems like the demise of Twitter, like a lot of people have moved over to LinkedIn. So there's a lot of good discussion happening on LinkedIn at a very high level. So I used to not like LinkedIn, but I like it a lot now.
Very cool. I will check it out. That's the one social media app I had before I quit. And I got to tell you, I never went back once I was out. I was like, that's only when I'm working and I'm not working anymore, but I should check it out. You're right.
That's where the conversations are happening now. So you should go check it out.
All right, buddy. Take care of yourself. Have a wonderful week. All right.
You too, Mike. See you later.
Thank you.